Hello, I'm Rebecca Hampson, financial journalist for well over a decade, during which I've written about ETFs a lot. I'm joined today by David Stevenson, columnist at the FT, Money Week, Investment Week, and myriad of other publications. Our plan is to discuss markets, what's going on, looking at the dollar, whether it's overpriced or not, what this means for markets, which way it could turn this year, and whether you need to hedge yourself. David, hi.
Hello, Rebecca.
June is a pretty big month. There's lots of meetings. So what should people be looking out for?
Well, there's the normal kind of run-of-the-mill interest rate stuff that's going on. By the time this has gone out, we'll have probably had the Feds and we'll have had the ECB, I think. And I think just looking down my list of things here, we've got the BOE, the Bank of England decision on the 21st of June. So, but we sort of know roughly what all that is. That's all about increasing interest rates. Well, maybe not in the UK, but probably increasing interest rates and the various central banks starting to scale back or even intensifying their scale back of their kind of quantitative easing. So we'll be all watching for the fairly obvious signs that the US Fed is worried about inflation. So the kind of core inflation rate's gone up to 2.2% in the US, and the kind of headline one is at 2.8%, and that will have, I think, probably freaked the US Fed out and will give any more narrative than they need really to increase interest rates. And the ECB will probably be under similar pressure to sort of increase interest rates and do something. But I think the other thing you've got to watch out for, looking down at my list of things, is the 22nd of June is the OPEC meeting. And oil prices, which I know we'll come back to, I think are quite interesting at the moment. They tell us lots of things about exchange rates and inflation concerns. And I think the other thing to watch out for, which I always watch out for, is I think it's on the 6th of July, I think we got the US non-farm payrolls, which is basically an indicator of job creation in the US economy. And the reason why, I mean, that's a regular measure that comes out. The reason it's interesting this time around, though, is people are wondering that the US economy is probably, certainly doing well, but could be what we use a term called late cycle, i.e. you've got a business cycle, and business cycles can last anything from 3 to 10 years, and we're quite long in the cycle at the moment. And that's sort of, how far along are we in the cycle? Are we as near peak capacity, which is where the inflation concerns come back in? If we are, you tend to see interest rates rise more sharply, and that tends to indicate a likely slowdown. Or have we still got some slack in the system in the US? Is there still a lot of job creation going on? And that's not quite black and white, that one isn't, because so people sort of relate job creation to unemployment, but actually there's a different relationship going on. There's a lot of people who are basically been off the job register, who are not technically unemployed, but are not active in the labour market, and they can come back into the labour market. And though the official unemployment levels are quite low in the US, as they are in the UK, the activity rates in the US, i.e. people who've withdrawn from the labour market, are quite high, and you could see a lot more of those come back into the labour market. So you can have a paradox whereby you can have very low unemployment but still a lot of job creation. And if the economy's got more slack in, then it could keep going up for longer, and that could stave off interest rate increases more. So US non-farms payroll on the 6th of July is one to watch out for.
Okay. You touched on rates going up, the Fed. We also have the ECB meeting, and you said the Bank of Japan, well, who knows what they're doing right now. But what does this mean for currencies?
Well, I think FX markets are where anybody who's interested in a kind of short-term speculative trading strategy need to really focus. Right. Because I think there's lots of stuff that's kicking around, and the FX markets are the kind of canary in the coal mine at the moment. They all tell you the way certain things are going. So the big story has to be the dollar. The dollar and the strength or the weakness thereof affects lots of things. It affects interest rates, it affects bond yields, it affects, in more indirectly, equities, certainly affects commodities. And therefore, the big story is what's the dollar? Where's the dollar at the moment? And at the moment, I can't work out. There's a paradox going on. So by many objective measures, the dollar should be weakening. Okay, and the reason it should be weakening is and I've talked about this on this program before in the past. Lots of technical reasons why. It's clear that the Chinese, for instance, are are probably trying to move away from being net buyers of US government securities to being a more neutral position. They're worried about their over-concentration on that. US hedging costs are very high at the moment, and that's freaking out a lot of people on FX trades at the moment. Other central banks are beginning to move into action, particularly we already mentioned ECB, and looking to, if not certainly scale back their intervention, and maybe even increase interest rates. So on many conventional measures, we should be seeing weakness in the dollar. And I'm not forgetting, Trump wandering around the world, annoying all of his allies, and talk of trade war. All of these things should, on many respects, be worrying investors and saying the dollar's overpriced. But actually, we've seen, for instance, the trade-weighted measure of the dollar, which is a bunch of exchange rates all added up together, and it gives you the kind of effective dollar rate. That's relatively near all-time highs, and it's actually strengthened in the last few months. And interesting enough, hedge funds have been ahead of that. So hedge funds are very net long the dollar at the moment. Numbers are coming out recently saying they're very net long the dollar. So there's something God going on, and the reason why it's really important, and the reason I'm labouring it, is there are only two narratives that make sense at the moment. Narrative one is the dollar is strong because people are worried. So it's a safe haven asset, and they're worried that there's more bumpy, volatile times coming, and that maybe there's trouble ahead. In which case, that explains why the dollar will be strong, and you'd be net long the dollar. Or the other alternative is we are basically kind of in a synchronized global recovery. The recovery is looking strong, and America's leading the pack, and everybody else is coming along with it. And the recovery is strong, and thus equity prices should be going up, in which case the dollar should be weakening. So, in my view, there's only two narratives out there. Either there's trouble ahead, or there's reasonably good times for all, okay? And if you believe that there's basically good times for all, you should be shorting the dollar like crazy at the moment. I.e., if we think this is a bit of a bump and that the global economy is in pretty good shape and the Chinese are busily pumping money into their economy, the dollar should be weakening. If, on the other hand, you believe trouble's ahead, you should be heading into safe haven assets, you should be buying US Treasury bonds, that kind of stuff. The dollar should strengthen. So, and the problem, and the reason I'm labouring so is because the equity markets seem to be predicated on the factor that it's good times, basically. Equity markets are powering ahead because they believe that the US economy is leading the global economy. If the dollar's strong and is telling you that it's a safe haven asset, you should be net short equities, US equities. But you can't have it both ways. So that's the problem at the moment. One of those two scenarios is true. And I don't know which of those two scenarios is true. But whatever effect is that sterling, I think that's the other thing, is I think sterling, consensus probably be short at the moment. And the reason for that basically is, we've already seen it come down from about 140, the cable rate from 140 to about 133. It's Brexit. And that ain't going away, and there will be lots of uncertainty around Brexit. And if the dollar is strengthening and there's lots of uncertainty around Brexit, then the cable rate, the dollar sterling rate, I would suggest is in line for weakening of sterling. And maybe if we have talk about a hard exit, come back in, it doesn't seem likely, but it's possible. And there's lots of worries about falling out the European Union. You could see the cable rate sterling go down past 130. So I think that's a move that a lot of people are beginning to get their heads around. That sterling, in whatever scenario, is probably looking fairly weak in the short term.
David, can you give me a bit more on why the dollar is weakening and what that's going to then lead on to mean for equities? And
well, the problem, I suppose, is the dollar's actually been strengthening in the last couple of months. But if it weakens, that again goes back to the narrative, which is that we have got a synchronized global recovery. And let's be honest, at the moment, that's what the data largely tells us. The data largely tells us, the macro and the economic data largely tells us that the global economy is in reasonably good shape.
Can we know that if until we know what the ECB have said?
Yeah, I think so, because the Eurozone recovery, which is going quite nicely, has slightly slowed down, but the story of the last few years has been kind of stop-start for a lot of economies, possibly the exception of the US has been pretty strong, consistently strong. But a lot of other economies have had a kind of, they do well, and then they have a kind of, they suddenly stall, slower growth rate, and then they pick up again. And I think what the equity markets have sort of made the assumption is that, which is why they've continued to do very well, with the relative exception of the FTSE 100, is that they've assumed that these kind of these stalls or these slower gears are then sort of ignored after 3 or 4 months, and then you see the economy's picking up again. And that usually tends to come in Q3 and Q4 of most financial years. So I think that the equity markets are sort of gambling on the assumption that the global recovery is probably still pretty strong. America's pretty strong. Europe has had a bit of a kind of little stumble, but will probably find its composure once we've dealt with those stocky Italians. And that by and large, profits, which they are, profits and earnings are going up. They are reasonably strong at the moment, and there's no sign that they're massively flagging. There are some kind of sectoral weaknesses. And if that's the case, you probably should be net long equities. Things like the S&P 500 would probably be kind of the kind of things you'd focus on at the moment, because the S&P 500 as an index is the clearest way of in a sense, playing that global recovery. As I said, the UK equities are slightly different, because UK equities, particularly FTSE 100, is affected by sterling. And sterling is, as we've already mentioned, a slightly independent variable, because Brexit sort of is happening independent of that global recovery story. And so when sterling strengthens, that's usually not terribly good news for the FTSE 100, and when sterling weakens, that's usually quite good news for the FTSE 100. So I personally think, in guesstimate terms, that I think the FTSE 100 is quite severely undervalued, and would probably be a bit long the FTSE at the moment. And the reason for that is that I think sterling will weaken, because I don't think anybody knows what our Brexit position is. And I also think that sterling is in reasonably strong, UK equities, particularly with their resource focus, are in reasonably strong shape. And we'll come to commodities later. We've got lots of big oil and mining companies that are reporting bumper profits and dividends. And actually, UK financials are in reasonably decent shape at the moment, the big banks. So personally, I think that the gap that you've seen in performance between the FTSE 100 and the S&P 500, with the S&P powering ahead relative to the FTSE 100, I think is a little exaggerated. And I would think that if we are in a global recovery, which I think on balance we probably still are, then I think you might see the FTSE 100 be seen to be undervalued, and maybe at that point outperform. I'd say all bets are off, though, if the kind of dollar strengthening argument is that we're actually heading into more volatile times and the global economy is stalling and the US is near the top of the cycle. And that's, keep going back to it, the FX markets, you've got to listen to what they're telling you. And at the moment, because the dollar strengthening, they're sort of telling you to watch out.
Sure. In terms of the dollar strengthening or weakening, this obviously doesn't just affect equities, it affects commodities, particularly oil.
Yeah, which is bobbing around,
Which has been, but it's been fairly volatile this year, although it's been on an upward trajectory.
Yeah, definitely,
As you say, we've got OPEC coming up. But I still don't know exactly what's going to happen, because we have the shale issues.
Does anybody know what's going to happen?
But is there what's the relationship between the dollar and oil?
Oh, it's very convoluted, and traditionally, there is supposed to be a fairly linear relationship between the dollar and oil, and certainly the dollar and commodities. It doesn't really work in oil, and the reason it doesn't, it does have some effect, but the reason it doesn't really work is there's strong structural drivers in oil which are independent of the dollar increasingly, and that's things like supply issues about whether or not OPEC can control supplies, US shale, US unconventional supplies, inflation concerns. There's lots of other independent variables that kick around with oil, and the dollar has probably much bigger impact, or a strengthening dollar has a much bigger impact on things like gold prices and other kind of industrial metal prices where there's a stronger relationship. But just sticking with the oil theme at the moment, the big story, which we keep sort of repeating, it is still true. It's moved out of a 40 to 60 trading range and it's moved into a 60 to 80 trading range. And which is what you said, which is since we've seen a higher kind of trending average. And I would suggest that that's unlikely. We're unlikely to see a kind of regime shift where we see the trading band move down to 40, 60 or up to 80, 100, i.e. out of the 60, 80. Because we've got this kind of supply-demand imbalance going on, is that there's not a lot of spare inventory around. there's strong argument for suggesting that we are quite close to the point at which you could begin to have shortage issues and inventory problems. If the Iranian issues really kick up and Trump decides to turn the screws even more in Iran, you could see some of that oil supply come off the market. Possible. And I think, therefore, how oil bounces around in a 60 to 80 trading range is very difficult. But it all goes back again to the dollar, and it goes back to the global economy. If the dollar is strengthening because it's telling you that they think that the global recovery is running out of steam, that's quite bearish for oil, because really the thing that's been pushing oil prices up, amongst many other things, has been the fact that the developing world, particularly the emerging markets, have been using more oil. Yeah. And they've been pushing up demand, and that's been cutting back into inventories, and that's allowed OPEC to sort of notch the price up. And if the dollar strengthening is telling you that people are worried about that recovery, and they're starting to buy dollars and buy US Treasury bonds, which are now around 3% yield, then that's negative for oil. In fact, very negative for oil, because it's very volatile, as you say. And if people think that key driver of increasing demand is going to be removed, you could see oil tumble out of its sort of, as I said, 60-80 range, back down to 40-60. As I said, I don't think that's likely, but who the hell knows? I think we are probably still in a reasonably decent global recovery, and we will see oil prices go up. But all bets are off if the strengthening of the dollar is telling us that there's trouble ahead.
That's interesting. I know that the Bank of America put out a report saying that oil demand is going to go up and the oil price is going to go up. And I know that the EIA put out a report saying that they've increased their projections, slightly, for oil demand. What, in terms of if the dollar weakens significantly, what does that then mean?
Well, presumably, in a bizarre sort of way, which sometimes goes against some of the linear relationships, it then goes back to my point, which is the dollar is going to weaken. What it's actually saying to you is that the global economy is doing well, and the demand for oil will carry on increasing. And as I said, there's already kind of issues around supply and inventory. And you're absolutely right, the Brent and WTI oil prices will go up, and we could see it push above the $80 trading range. Now, of course, there's a kind of negative feedback loop going on there. The negative feedback loop that's going on there is as that feeds back into inflation. And we've, as I said already, we've got US kind of headline inflation rates at 2.8% and core at 2.2%. And that will worry the policymakers in the US Fed, and that will make them even more determined to push up interest rates. And if they're even more determined to push up interest rates, that makes US Treasury bond yields possibly pushes them up. You start going above 3% and then for 10 years, and then you're above 3.5% for 10 years. And that then freaks out the equity markets, because equity markets think that actually, US Treasuries start to look more attractive because interest rates are going up and people sell equities. And then you end up having a slowdown. These feedback loops are really terrifically important at the moment. And the US Fed has got a very difficult balancing act at the moment. It clearly has to raise interest rates, and it will raise interest rates, but it's got to do it at a measured pace. If it does it too drastically, and it really shoves up interest rates because they're worried about inflation from increasing oil prices, that could just stall that US risk recovery. And with midterms coming up in America, I'm fairly sure that there's one person sitting in the White House who doesn't want to see the recovery stall at the moment. So it's a really difficult balancing act, and this is the turning point that all investors need to watch out for. We are coming to the point at which we'll start to get signals about whether or not we should stay fundamentally bullish about risk assets, like equities and all that kind of stuff, or fundamentally bearish, and watch the dollar. Because that's sort of telling you what you need to know. And watch US interest rates. Again, nothing new there. But you need to watch this stuff very carefully at the moment, because we're at this kind of regime change point where you move out of one kind of consensus to another, and no one quite knows where we're going to jump at the moment.
Okay. You mentioned earlier that we're late in the business cycle.
Yeah, very late. Well above the average length of the business cycle.
And you just touched on the bonds, particularly the 10-year
US Treasury.
At which point do people start needing to worry?
I'd say between 3.5% and 4% for US Treasury bond yields.
Why is that?
It can probably anything above 3, and it's interesting actually. I thought that we have seen it move above 3. I think it went to about 3.1, and then it's sort of come back down again. By the time you watch this, it'll probably be back up again. But actually the 3% line has held fairly consistently, but there is evidence that anything from about 3 to about 3.5, 3.75, something like that. Actually, equity markets do all right, because what that's sort of telling you is that the Fed's tightening slowly because the economy's doing well, but it doesn't tighten too drastically, and therefore it's kind of Goldilocks scenario, interest rates going up but gently, and everybody's happy. Once you get above 3.5, sort of 4%, certainly 4%, that usually tells you that the Fed's tightening because it thinks inflation's out of control, it's going to whack up interest rates, and everybody expects the economy to slow down. Because bear in mind, equity prices tend to be kind of what they like to think they are, 6 to 12 months ahead of the cycle. And at that point, they'll be beginning to think, crikey, this is worrying. Interest rates are 4%. Interest rates have hit 3%, 3.5%. Yields have gone up past 3.5%, 4%. Crikey, there's a recession on its way. Sell off. And then people start moving into treasuries, because at that point, treasuries are a nice relatively risk-free asset. They can pick up 3.5%, 4% without any particular worry, and equities sell off. So we're at this really interesting point where the 3% line's holding, and at the moment, that's probably pretty good news for equities, US equities in particular. It will probably still be quite good news as it heads towards 3.5. Once it starts to, that's the Treasury 10-year yield. Once it starts to get above 3.5, equity investors should watch very carefully, and you need to start thinking about hedging at that point.
Talking of hedging, now that we've talked about what's happening and whether it's good or bad, how can people hedge themselves against a weakening dollar? Let's start with a weakening dollar.
We don't really need to help hedge themselves against weakening, because the best hedge with a weakening dollar, US equities will probably carry on doing quite well, and you'll probably see other equities like Japanese and European equities do quite well, particularly European equities. So, and in fact, you don't really need to hedge yourself. You just need to be long risk assets at that point if the US dollar's weakening. And if the US dollar's weakening, that's also pretty good news for emerging market assets. You probably don't need to hedge yourself at that point. You just probably stay in that long position. But you may redistribute your assets away from the US.
Right,
That's the crucial distinction. You may go, well, you know what, the US is looking pretty overvalued at the moment, and I'll start buying European equities, which is what has been happening, by the way. That has been the trade. If you have a strengthening dollar, and it's the strengthening dollar is telling you that people are worried, then you do need to think about hedging. And there are probably 3 mechanisms for hedging, all of which you can use leveraging. The first one is that you'd probably be looking at FX rates, because you'd probably be looking at the cable rate, sterling dollar pair, because you'd be looking at sterling weakening and the dollar strengthening. So that would be classic hedge number 1. You won't get a lot of volatility there, because that rate never moves violently. Because you're never going to get the cable rate going from 1.3 to 3. Or 2, because it doesn't work that way.
But you could maximise your returns with.
Yeah, absolutely. So that's where leverage plays in. The second way you could probably hedge your portfolio is you'd probably be looking at gold. That's the classic hedge. Now, gold has a slight problem initially. In the first phases, gold has a slight problem with the strengthening US treasuries, because, of course, people effectively use US treasuries as their safe harbour asset. And sometimes gold doesn't do terrifically well in that kind of first instalment of the panic. But then quite often when that panic begins to become infectious and everybody worries about the global financial system going into meltdown, then actually suddenly gold reappears on the radar again, and then gold becomes quite attractive at that point. I think the chances of a nasty bump in the middle of the night are increasing exponentially over the next 2 years. And gold's been fairly steady, actually. It's held within the 120, 1250, 1350 trading range. A lot of physical sellers of gold, but a lot of kind of paper and options buyers of gold, so they sort of balance it out. And gold could suddenly come back into favour. And of course, the third thing is you just go short. Equities. I mean, risk assets are going to do rather badly at that point, and basically you just go short any risk asset you can get your hands on. And I would suggest that the probably at that point the riskiest assets are sitting in America because they're quite highly valued. Valuations are quite high on US equities. And you pick an index like the S&P 500 and you say, well, I'll go net short that, and I'll look at kind of hedging out my portfolio. So, and the last option, you just go cash.
Mm-hmm.
Cash is always a quite good hedge in a kind of slowdown because you can keep your powder dry and use that money later on to buy assets that are much cheaper than they are today because they've gone down in price. So cash is a natural harbour, and I suppose also, as I said, people buy US Treasuries. You'd go long US Treasuries at that point because if you're getting 3.5%, your price cap, 3.5%, 4%. That's a nice yield to have as long as US Treasury capital prices don't fall radically.
I just have one last question on gold, very quickly.
Yeah.
If there are physical sellers,
there are
does
lots of them.
that not indicate that people are not expecting anything bad?
Yeah, absolutely. And it's very interesting. I saw two kind of indicators on this. First indicator is that I've picked up recently that India, which is traditionally a big buyer of physical gold, has been net short for a long time. There's a separate factor going on there. It's all to do with the government's reforms and demonetisation.
Mm-hmm.
So the government under Prime Minister Modi has basically brought in this new regime, which effectively encourages people to move into formal economy.
Mm-hmm.
And what that's actually meant is that people have been selling gold and sticking their money in a bank account in very direct ways because the bank accounts are more reliable than they used to be. So there's been more physical selling of gold in India, China less so, but India certainly. And the other one which I saw is an outfit called Bullion Vault, which is kind of investment gold website, and you can buy gold and it stores it in there. And they've been noticing over the last couple of months that there have been net sellers on their system. And yes, you're right, that's usually a negative sign. But the only thing I'd say is that that negative features might be through independent factors. So India is a classic example. They might be net selling because they're having they're reforming their economy and they just put in their money in cash. It didn't tell you anything about gold. Yeah. Even with bullion vault, it could just simply be that lots of people bought gold when it was much cheaper, and now they're taking profits. You should be careful about using signals as a kind of like, oh my God, that's telling us that gold's overvalued. It just could tell you that people have made lots of money and they're selling it. I'm not particularly bullish on the price of gold over the next few months.
Right.
But I would be more bullish on the price of gold if we felt there was a genuine systemic threat and that we're about to slip into a really nasty slowdown. And the central banks have no weapons left to fight that slowdown. At that point, gold becomes more interesting.
So buy now.
Arguably, the argument is the contrarian would be out there buying now. Exactly, the contrarian would be saying, actually, gold's found a support level. Yeah, it's probably not going to go a lot below that. And that if we have, a real threat of a global financial crisis, and we really should not underestimate that there's a chance of that over the next couple of years. Your debt levels have gone up. The central banks don't have, with the exception of Americans, many weapons to fight now, except for things like helicopter money. If there's a slowdown, they could be in trouble. And at that point, all the fears about the global financial crisis come creeping back out again, and people really start to worry and panic. And at that point, gold is very, very, very useful at that point as a hedge. I don't think that's likely at the moment, and I don't think that's necessarily probable over the next few years, but it's not impossible. And at that point, gold becomes interesting.
Okay. Just summing up, what is the bottom line, and what should we be looking out for over the next few months? Well,
crucial. I mean, the VIX, which measures volatility of the equity markets, the S&P 500, is crashed back down again.
Yes.
And that's usually a contrarian indicator. There's trouble ahead. When VIX gets down to about 12 or even single figures, that usually tells you that there's being a bit too complacent. I think whatever happening is, that's why I keep going back to FX rates. The various markets and the various signals are telling you that there's likely to be more volatility ahead for all sorts of reasons that we've already articulated. And that means that if you take a more active view about certain asset classes, be it gold, be it oil, be it equities, be it exchange rates, you're likely to see more volatility up and down. So that's one key signal. Yep. Okay, I think we're possibly moving from all risk assets do really well and they all rise at the same rate to a more differential situation. So you can pick your investment ideas. That's number one. Number two, if you're looking at safe harbor assets, then the dollar looks attractive because it's got momentum behind it, and gold could be attractive in the long term. I think sterling, probably, my gut feeling is sterling is probably fairly weak in the short term, simply for obvious factors like Brexit, because none of us know what's going to happen, so there's a lot of uncertainty. So that's sterling probably weak and weakening. Bonds, US Treasury bonds will probably keep testing 3%, probably go a little bit higher, possibly a lot higher. And you've got increased interest rates. And look, there's nothing complicated about increasing interest rates should tell you that there's more volatility. That's what they're telling you. And therefore you need to start thinking about hedging. Going back to the last point, even if you don't implement your hedging now, you need to have a strategy to implement and work out what instruments you're going to use to hedge and what you're going to do and what you're going to sell and what you're going to buy. Increasing interest rates and big moves in the FX markets are telling you to think about it and have a plan.
Great.
Pleasure.
Thanks so much, David.